Let's have a session on fiscal policy and monetary policy. We'll start with fiscal policy. So fiscal policy is controlled by the government, the big G, and it's the use of taxes or government spending to influence the economy. Influence the economy in terms of economic growth. And if economic growth is improved, it's likely to lower unemployment. And also the balance of payments. Think about trade, the difference between exports and imports, and the government would want to boost exports. So if we think about fiscal policy, taxes and government spending are the two key areas one must look at. And we're thinking about expansionary fiscal policy. Expansionary fiscal policy is about increasing economic growth. The opposite of expansionary is contractionary. So taxes, but there's different types of taxes. So we might look at different types of taxes. So personal taxes, for instance, income tax. If income tax were reduced, that will mean more people have money in their pay packets, and that would increase disposable incomes. If it increases disposable incomes, it's likely to increase the demand for goods, probably more so luxury goods. Those goods with an income elasticity of demand, a YED of greater than 1. The next type of tax is business taxes. So business taxes could be corporation tax. Corporation tax, well, if it's reduced, it will lead to company profits increasing, and that might lead to companies, well, it may lead to them increasing their investment in capital, in expansion, and so forth. The next type of tax is spending taxes, such as VAT, value-added tax. And if VAT were reduced, that effectively means prices for goods and services are reduced, and that will increase the demand for those goods and services. However, it will be even more the case if the PED, the price elasticity demand, is elastic, is sensitive to price changes. So all of that is tax reductions, but remember, different types of taxes have different effects, and this is all to do with tax cuts, so it's expansionary because it's going to promote economic growth. The other angle is government spending. So the government might increase its spending. Remember, the government spends money on welfare, on education, on the NHS, on defence, on infrastructure to build bridges. And also, just think, if the government increases its spending, this is expansionary, and it will lead to economic growth increasing, thereby increasing gross domestic product, GDP. But one thing to think about with government spending is it might be specific to certain industries or certain locations. It could be a certain industry is benefiting from government spending, like agriculture and subsidies. Or it could be a certain area is benefiting from a particular piece of infrastructure, like a bridge or a train track or an airport or a seaport, and therefore a particular location has benefited from that government spending. So that's fiscal policy. Now let's look at monetary policy. So monetary policy is controlled by the Bank of England, our one central bank, and the monetary policy is using interest rates or the money supply to influence spending in an economy. Now, the Bank of England is in control of inflation. Inflation is judged by CPI, Consumer Price Index, and the aim is to have it at 2%. Let's look at interest rates. My throat's hurting. So, interest rates, consumers and producers, two ways to look at interest rates. And we must appreciate that there's different effects on those. So, if consumers are faced by a lower interest rate, well, that's going to lead to less incentive to save because there's a lower interest rate. So it might lead to the fact that they're saving less, then spending will increase. Also, a lower interest rate will mean it's cheaper to loan money, so they're more likely to demand loans. Additionally, cheaper mortgages might mean that disposable incomes increase as a consequence. And that might be a greater benefit to luxury goods. Again, those goods with a YED greater than uno, greater than 1. Now the effect on producers. Interest rates fall. Cheaper to finance expansion. Cheaper to finance investment. Helps businesses that have high gearing ratios. We'll think about those financial ratios. And debt becomes more attractive versus equity because it's cheaper to service debt than it is equity. So that might be also a way you think about the capital structure of your business. And clearly with interest rates coming down, that is boosting the economy. So it's an expansionary monetary policy. If interest rates were to go up, that would be a contractionary monetary policy. Now the last one is the money supply and the mutation in the last decade or so being quantitative easing or QE. So let's go through QE and how it works with monetary policy. So quantitative easing is essentially an increase in the money supply. So the Bank of England, the central bank, creates more money electronically, and then they go and buy up government debt in secondary markets. They buy that from financial institutions, banks, and then banks theoretically should have more capital, more cash to loan out to consumers, to producers. So then it encourages them to issue more loans. And if they issue more loans, then that hopefully leads to expansion, to spending, to investment. And that increases demand for goods and services. And that's why QE, or expanding the money supply, is expansionary monetary policy. See you at the next sesh.